July was a really big month in the stock market. The S&P 500 was up 9.1%, which was the best month since November of 2020. Now, here is why I don't think that we're in the start of a new bull market. Like I've seen some articles written. I saw one specific article that said we saw our low on June 16th of 2022 and a new bull market's in full force. I don't believe that's happened. What do I believe? I believe that we did a bear market bounce. All we did was we sucked people back in. When I see all my random friends who were never into stocks before suddenly saying, oh, see, Paul, thank God it's over. July, the market's back. We're doing great. That's what makes me go, okay. That's the first thing that makes me say, this isn't done yet. Second thing is we're still based on the three most reliable metrics for long-term valuation in the market, stock market to GDP ratio, the 10-year cyclically adjusted PE ratio, and the price to sales ratio. All three of these are double what the historical average are. That tells me we're not done. We have a lot more to go. This market will fall a lot in the next few years. Does that mean we're going to see, I know when the bottom's going to happen? Absolutely not. Just like I had no idea when the top was going to happen. I couldn't believe that we hit a 3,300 level at COVID, right before COVID, fell to 2190 at S&P, and then went right up to 4,800. That blew my mind. I would have never guessed that would happen. So keep that in mind. I never know when things will happen, but I know they will eventually happen based on long-term valuations. Okay? Second thing, in July, we had the announcement of the second quarter of negative GDP growth. That is the technical definition for a recession. But of course, the White House has come out and said, no recession whatsoever. Look at unemployment numbers. And they're right. Unemployment was announced at the low, not the low, but 3.6%. And if you go back in history, this is an astronomically low unemployment rate. Even during the 2000 tech explosion and growth of the late 90s, we didn't hit 3.6%. But you've got to remember, unemployment is a lagging indicator to the economy. What does that mean? It means that it changes after the economy has changed. It's not a leading indicator, it's a lagging indicator. It changes after the fact. Point number 3, I want to remember. Recessions are never announced. I shouldn't say never. I don't remember the last time a recession was announced right when it happened. It's usually 6 to 12 months later that people say, oh, recession started here. Big reason is because of this. Unemployment's a lagging indicator. Now, am I want to sit there and say we're in a recession? Well, I will say this. I don't like the GDP numbers. And the other number that came out in July was consumer sentiment hit 51.7, which was an increase from the previous month of 50.0. You sit there and say, oh, it's an increase. But going back to 1952, the previous low was in 1981 when it was 51.7. Sorry, this is 51.5. So again, last month we hit 51.5, which was higher than the previous month of 50. But I want you to remember, before these two readings, the previous low was 51.7. So what is consumer sentiment index? It basically asks people, how do they feel about the economy and how do they feel about their spending in future months? If it's this low, it means they're not going to spend money. 70% of US GDP is consumer spending. That is a huge number. If people just pull back 5% of their spending, that's 3.5% of GDP gone. So what is my take? My take is we're probably going to look back at today and say we were in a recession at this point. Could I be wrong? Absolutely. But guess what? I don't care. Because what we're trying to teach here, if you're new to this channel, we're trying to teach long-term fundamental investing. Don't get caught up in the day-to-day news, all these things that happen. You want to focus on the long term. Interest rates were just increased again 0.75%. Why? Because of inflation. Inflation has come out. Guys, couple all of these things, consumer sentiment, inflation, GDP contracting again. You have all of these things happening, and I sit there and say, is it possible that we're not in a recession? Sure. But if you ask me, what would these three things look like if we were in a recession? I would say probably what we just posted up here. And that's the thing that causes concern for me. Don't look at unemployment. Unemployment is a lagging indicator to economies. Once people realize we're in a recession and companies start laying people off, that's when you start to feel it. Remember, look at COVID. People didn't start these companies didn't see COVID happening. They laid people off after COVID. Go look at the financial crisis. People were laid off after the financial crisis started. That's the key of what makes the spiral get worse and worse. So going forward here, what are we trying to teach? Well, I'm a value investor. So my goal is to teach a long-term decision-making based on what you see in the long-term perspective. Every single day, there's good news and bad news. If you get caught up in that day-to-day news, you're going to drive yourself crazy. When it comes to investing, this is the stock market over long periods of time, but this is how the prices actually go. This is why I preach dollar cost average. Look at July. July was up 9.1%. If you weren't dollar cost averaging, you were like, oh, what did I do? But even then, I would sit there and say, we're trying to teach habits here. We're trying to teach small habits that lead to large gains, like the book Atomic Habits. You want to invest every single month, year, whatever it is, as long as it's consistent. Why? Because you never know when we're going to be overpriced or underpriced. And your job is to pay every single month. And guess what happens? Your average will be this. The average investor, when the market does 9.9% over long periods of time, makes 2 to 3%. Why? Because they're usually buying here and selling here. They're buying at peaks and selling at bottoms. Oh my God, I can't miss here. Oh my God, my money's going to zero. And it's the exact opposite of what they should be doing. They should be, if you just take the emotion out of it, take thinking out of it, guys. How much easier would your world be if you sit there and say, I just dollar cost it, I just take all the thinking out of it? That is a wonderful, wonderful feeling when it comes to investing in your life. And if you are smart and you live well within your means and save your money adequately, nothing's going to be able to stop you. Yes, you might get laid off. But if you saved your money and you spent well within your means, a layoff will only be a temporary problem for you. Go look at every recession in history. There have been some dark, dark times out there. Terrorist attacks, assassinations, all these world wars, all these world events, rising gas prices, increasing inflation, increasing interest rates. And guess what? The economy always ended up better afterwards. Does that mean there was no pain? Absolutely, there was pain during it. But your job is to limit your pain. How do you limit your pain? Be more responsible. Live within your means, save your money. Try to save 15, 20% of your money, and the more your income is, the larger percentage it should be. Seth is our co-host. His income has gone up significantly over the last year, and he's saving a good amount of money. But I tell him, as your income goes up and up, try to save half of those extra tax dollars. Don't go spending it. Because if all of a sudden Seth was fortunate enough to make $2 million a year and he's saving the same amount as when he makes a fraction of that, that's not good. Because you get accustomed to a certain lifestyle, and then it's hard to keep that lifestyle up if something bad happens. That's what I do. Everybody teases me, Paul, if I had your money, and they say blah, 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 and I respond with, if you had my money, you'd be broke. Because having money is great, but if you're not financially smart with it, it doesn't matter. You're going to have financial problems. In the book, The Psychology of Money, Morgan Housel talks about the people out there who do the best, the ones who started the earliest and just gave it time. The earlier you start and the more committed you are to the process of saving, you will outperform everybody else. That is the goal here. That's absolutely, get the habits in. So if you're new to this channel and you like what I'm saying, subscribe to us, because this stuff will change your life. These habits you get into, and it take time, but I'm constantly learning. I'm 41 years old. I've been learning investing since I was 13. And guess when I'm going to stop? I'm going to stop the day I die. That's when I'm going to stop learning about investing. It's a lifelong process. July was an amazing month for stocks, but I'm telling you right now, if you think the worst is over, I hate to break it to you, the worst isn't anywhere close to over. It will happen again very, very soon. When? I don't know. But at some point, we're going to go a lot further down in stocks. If you want my guess, stock's probably going to fall another 40 or 50% from today's levels. And you might sit there and say, you're crazy. I can't wait to see the comments in the chat. You're crazy. Yeah, just like I was crazy saying that Peloton and Palantir were at 180. Peloton was worth about $10, and now we're to that, about $10. And Palantir was at 40. I said it was about $5. It's at $10 right now. And I can go down the list. And yes, I've had my stocks go down. But those are stocks that I believe in, and I understand their cash flow and not their hype, and I keep buying them as they go down. Do I reassess the investment? Absolutely. But your job is to create a process that works and stick to that process. I appreciate your time. Thank you very much.